Ladies and gentlemen, good day and welcome to Shankara Building Products Limited Q3 and 9 months FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sukumar Srinivas, Managing Director of Shankara Building Products Limited. Thank you, and over to you, Mr. Sukumar.
Good evening, everyone. On behalf of Shankara Building Products Limited, I extend a warm welcome to everyone on the Q3 and 9-month FY23 earnings call. I have with me Mr. Alex Varghese, the CFO of Shankara Building Products Limited, and Mr. Dhananjay Mirle Srinivas, Vice President, Business Development, and SGA, our Investor Relations Advisor. I hope all of you must have had a chance to look at our investor presentation that is uploaded on the stock exchanges. A quick look into the industry dynamics and business scenario in Q3 FY23. The year 2022 saw a recovery for the construction material sector. The industry experienced a robust rebound thanks to the emphasis on infrastructure development and the rush to acquire real estate assets. The building material sector recovered and moved in the direction of pre-COVID levels. In 2022, the industry saw a 10% rise. The industry is not showing any indications of slowing down as 2023 approaches. On the contrary, it is headed in the direction of rapid expansion. Growth in the building materials industry is crucial for the economy as a whole, because it employs more than 51 million people and accounts for roughly 9% of the nation's GDP. One of the main factors influencing the sector's growth is the government's goal of creating a $5 trillion economy, $5 trillion economy, and the resulting investment in infrastructure. The budget of 2023 will boost the prospects for the building material product companies and the steel sector in India. The budget provides rupees 10 lakh crores for development of the infrastructure sector. The increase in outlay in the Pradhan Mantri Awas Yojana and the Jal Jeevan Mission both appear to have a positive impact for the steel sector and the building material sector in general in India. Coming to the company's financial performance. Shankara has achieved a stellar performance on the back of revival in infrastructure real estate. We have achieved our highest ever quarterly sales, with revenues crossing the milestone of rupees 1,000 crores for the quarter. All the segments performed well during Q3 FY23. We have registered same-store sales growth of about 70% during the third quarter of this financial year. We have seen higher footfalls in our retail stores, and online channel has also performed well. The company's consistent efforts over the last few quarters have helped us efficiently manage net working capital. Our working capital cycle for Q3 came in at under 1 month, about 26 days, and a positive cash flow of rupees 95 crores for the period ended 31st December 2022. In the 9 months of the financial year, our company recorded a total revenue of rupees 2,820 crores, a growth of 72% year-on-year. The retail business did a revenue of rupees 1,561 crores, a growth of 61%. Channel and enterprise business stood at rupees 1,259 crores with a growth of 89%. Karnataka continued to be the major contributor of our business, having a share of 47%, followed by Kerala, Tamil Nadu, Telangana, Andhra Pradesh, and the rest of the states. Our store matrix continues to show healthy traction. In Q3, we recorded an average ticket size of rupees 45,000 versus rupees 37,138 in the same quarter of the previous year. Our rentals per store remained stable. We recorded an SSG of 70% year-on-year basis for Q3. I will now ask Dhananjay Mille Srinivas to give you a brief update on the building materials retail segment.
Hello, good evening everyone. I would like to begin with a quick overview of the products in Shankara's building material life cycle. As you might be aware, we supply materials starting from TMT, cement and construction chemicals, to plumbing, sanitary ware and fittings, tiles, adhesives and surfaces. We also have electrical, lighting, paint, modular kitchens, hardware and appliances that form a part of our portfolio. Last but not least, MS Tube, structural steel and roofing solutions complete our basket of offerings. There has been an increase in retail walk-ins in the last quarter, and we feel our brand equity has grown. We are focused on an increase in sales from the verticals of tiles, electricals and lighting, and a push towards more luxury brands expected by customers in Tier 1 cities. Our focus continues to be on technology, where we are working towards increasing our presence through digital marketing for our website and mobile application. Last quarter, we saw a growth of 25% in online inquiries and a 35% growth in store visits. This is in line with our vision of eyeballs to footfall. There was a 5% month-on-month increase of visibility for our website. Our web performance index has grown from a score of 56 to 98 for the desktops and 21 to 80 on mobiles, thus ensuring easier access and ease of movement through all the pages and links of our website. Overall, we have seen an increase in traffic by 82% as compared to the previous quarter, and 92% of the traffic growth was through organic means. We continue to utilize technology to improve our customer acquisition and retention. We at Shankara are working towards customer transparency in the building materials life cycle. We believe customers and influencers need more clarity and visibility towards the fast evolving building materials industry. Shankara works with a customer-first approach. Customers can get a better understanding of all stages of construction and view the material and brand appropriate for their needs. Our stores pride themselves on product knowledge, and we utilize technology to share this knowledge with our customers. This helps them optimize their purchases. Our technology-enabled approach rewards customers for loyalty and offers them choices and prices unmatchable in the market. Overall, it's been a good quarter, and we hope to continue this in the coming months with a focus on non-steel and technology-enabled growth. Thank you.
I would request Mr. Alex Verghese, our CFO, to talk about the financials briefly.
Good evening, everybody. In Q3 FY23, our revenue came at rupees 1,080 crores, registered a growth of 85%. EBITDA came in at 33 crores, registered a growth of 114%. The margin came at 3.03% with a growth of 42 basis. PAT came in at 16.4 crores versus 3.5 crores in previous year same quarter. For 9 months FY23, our revenue came at rupees 2,820 crores, registered a growth of 72%. EBITDA came in at 89 crores, registered a growth of 57%, and the margin came at 3.15% versus 3.46 in the previous period. PAT came in at rupees 43.9 crores versus 18.8 crores in the previous year same quarter. We have considerably reduced our debt level. As at Q3 end, our gross debt stood at rupees 73 crores, and with cash and cash equivalent, we are at a comfortable net debt position of rupees 45 crores. As we improve our revenue throughput and product mix, we expect higher benefits on the working capital front. Our return ratios are also improving, and we expect it to improve in the ensuing quarter and the coming year. Thank you.
This is all from our end. Thank you for your kind listening. We will be happy to answer any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Gunit Singh from CCIPL. Please go ahead.
Hi, thank you for this opportunity. So, sir, my question is regarding the margins that we're operating at. So, for this year and also for the quarter, we are operating at 3% margins, while pre-COVID, around financially 2017 to 2019, we were operating at 6 to 7% operating margins. So, what should be the steady-state operating margins that we should look at, and do we see others going back to these margins? And what is the reason for the margins going down? That was one of the questions.
Yeah. I think we had very clearly stated very much in the beginning of the year that we are moving towards more of a marketplace model, and we are also focusing aggressively on our revenue growth, which had come down quite a bit in the COVID period and maybe a year before that. So we are very clearly focused on rapid revenue growth, and there is definitely the kind of competition that we are facing thanks to the numerous building material marketplaces and startups that have come up. So I think we are very aggressively focused on top line, and therefore there is definitely a slag on the operating margins that have come down. But we are confident that with the kind of revenue growth that we are talking about in the next 2 to 3 years, probably the kind of operating margins that we are looking at will come back, may not be to the entirely to the pre-COVID, maybe the 17, 18 kind of numbers, but it will definitely improve. Further, we have been focusing a lot on our balance sheet in the lines of bringing down our working capital cycle. So I think that has been the focus of the company in the last 2 to 3 years. And I think we have been fairly successful at that. We've also grown substantially. So this is broadly where we are as at present.
All right. And what would be the internal projection for growth in next year? And I mean, we're not coming back 6 to 10%. So what would be your internal projection for the steady-state margins that we might reach maybe next year or 2 years from now? And when do you expect us to reach those steady-state margins?
Sorry, could you just repeat the last part of your question? A little louder. I don't know, we're getting a very poor audio. So if we can just speak a little louder, it will help us.
Sure. So last part of the question is that the steady-state operating margins that you have mentioned, which you said is maybe lower than 6 to 7%. But I mean, what are your projections for the steady-state margins that you will reach probably say next year or the year after that? And when do we expect to reach these steady-state margins, which are higher than what we are doing right now?
Yeah. I think we are very confidently projecting at an EBITDA level. We are at around 3.5. We are very confident of sustaining that in the coming year. We are also looking at a further fairly rapid growth in the coming financial year. So I think we would broadly stick to probably in the region of 30% plus top line growth and around the same 3.5 kind of an EBITDA level as of the coming year.
All right. Is that 13% or 30%?
Sorry?
The top line growth you mentioned number is 30%?
Yeah, we are looking at in the 30 to 35% growth in the top line.
All right. Perfect. That's all from my side. Thank you.
Thank you. The next question is from the line of Karan Mehta. Sorry, the next question is from the line of Nehal Jain from SK Securities. Please go ahead. Mr. Nehal Jain, please go ahead with your question. The line is unmuted.
Your voice is not audible, madam. Can you speak little loudly?
Can you hear me now?
Yeah, much better.
Mr. Nehal Jain, please go ahead with your question. Your line is unmuted. As there is no response from the line, we'll move to the next question, which is from the line of Kiran Mehra from Mehta Investments. Please go ahead.
Hello, am I audible?
Yes, you are.
Yes.
Please go ahead.
Yeah. So congratulations on very good set of numbers. So can you explain what has helped us to achieve this sales growth? What has been the key growth drivers?
Yeah, thank you, Mr. Kiran. One of the key factors, I think, is the sheer demand itself that has gone up, which we had talked about in the presentation, is number one. Number two, I think Shankara also has been very aggressive. So I think we would have also captured taken a larger share of the pie in the market. So I think these two factors significantly contributed to the good growth in terms of the revenues.
Okay, great. So what is our sales mix in terms of steel to non-steel in terms of revenue?
Yeah. In the non-steel would be in the region of around 12 to 14%.
Sure, sir, that helps. Sir, I will join back the question queue. All the best.
Thank you.
Thank you. The next question is from the line of Devendra Pandey from DP Financial Advisory Services. Please go ahead.
Thank you. Good evening, sir. So I have a couple of questions. My first question is on the recently announced budget. So, sir, what are your thoughts on the recently announced budget and how will it help the industry or business in general?
I certainly think the budget is very industry friendly, number one. Number two, when we look at the kind of announcement which I mentioned earlier in my speech regarding the kind of allocation for infrastructure, which is 10 lakh crores, I think there is a huge benefit that people like us are going to, the entire building material industry and the infrastructure, whether it's steel, cement, etc. I think it's going to see a very good upside in terms of the demand. Further, the multiple housing sector allotments in the various Prime Minister's schemes that are coming about also seem to be very positive for our industry. So I do see that the budget overall has been a very, let's say, a good budget as far as we are concerned.
Understood, sir. And can you share the demand outlook and business dynamics on retail, enterprise, and channel side of the business?
Sorry, I didn't get that question.
Can you share demand outlook and business dynamics on retail, enterprise, and channel side of your business?
Yeah. The retail basically is the kind of walk-ins, the kind of stores. We've got about 90 stores, the walk-ins that come into that business. And Alex, can you just take the one retail element?
So the retail, we are doing around Q3 within around 595 crores of revenue. And we have seen the segment, it is around 7% segment EBITDA. Yeah.
Okay, sir. Got it. Thank you.
Thank you. The next question is from the line of Riya Verma from NR Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. So I have two questions. Firstly, if you could throw some light on the DIPA business.
Madam, a little louder. We are not able to get you very clearly.
So I was saying, if you could emphasize on the digital side of the business.
Digital size of the business. Right.
So currently, our true online sales, genuine on-channel sales is around 80 lakhs per month. But the true number kind of would be a mix because we have this policy of eyeballs to footfall. So we actually encourage a lot of customers to use our digital platform to kind of understand about the product, understand the material, and we kind of bring them into a store to get the real experience. So the true online numbers be around 80, and what happens is a lot of chatting and offline. There are a lot of we have a talk to an expert and a lot of things on our website. So what ends up happening is a lot of customers come offline after doing a preliminary search online.
Right. And secondly, are we facing any challenges on cost inflation per se for steel products?
I'm sorry, I didn't get that.
Are we facing any challenges on cost inflation for steel products?
Steel, yes, but it has been a very fairly volatile market over the last 9-10 months. So it has actually come down continuously. Then now it is stable, again rising a little bit. But I think the steel business is such that we've got to sort of live with it. So I think we've sort of balanced it out, trying to hold the kind of correct optimal inventory and so on.
Okay. Thank you. That is helpful. Thank you.
Thank you. The next question is from the line of Praful Rai from Arjav Partners. Please go ahead.
Yeah, am I audible?
Yes, you are. Please go ahead.
Okay, yeah. Looking at 3-4 years down the line, how do you think your business is going to be? Hello, am I audible?
Yeah, there's some disturbance in the background.
Just hold on. Now it's good?
Yeah.
Yes. So I was intending to ask, you're looking at 4 to 5 years down the line. How do you think your business is going to pan out?
Okay, 4 to 5 years down the line, how the business is going to pan out? Yeah, I think we will be a very well-entrenched building material player, definitely higher than a top line, which should be definitely 10,000 crore plus. Yeah. And we should be much deeper presence in many pockets of India, which we aren't currently. And we also hope by then that our non-steel business will be definitely in the range of 25 to 30% of our current business volume. And it's 25 to 30% of the total business volume. So this would be broadly the top line approach.
Yeah. And also looking at the current fixed assets and everything you have, how much of the peak sales you can do with all these facilities?
What is the kind of peak sales?
Yes, you can do with your existing plant.
So, I think, with the limited addition in infrastructure, we can easily go up to what the kind of numbers I was telling you about.
All right. Yeah. Works. Okay. All the best. Thank you.
Thank you.
Yeah.
Thank you. The next question is from the line of Arun Tirumalai from Tavasya Capital. Please go ahead.
Yeah. Good evening. I just wanted to understand in terms of when you talk about the future growth, right? What is the number of store additions you're looking at? So currently we're at 91. So how many stores would you look? Do you have a breakup in terms of the next 3-4 years? Where in terms of number of stores you want to be? That was the first one. And secondly, also in terms of steel versus non-steel. So if you can just give us some color in terms of the margin profile, in terms of how much is the, say, overall EBITDA, say about 3%. So how much of it would be non-steel? Would it be slightly higher than steel? And how does that look? So just if you can clarify. And also in terms of digital, how much of the percentage today? It's negligible, I understand. But going forward, do you see digital also in the 3-5 years? What proportion of sales would come from that as well?
Sure. I think the first question is on what kind of store rollout plan we have. We have been actually in the last 4 years, we have shut down some stores. We also saw that there is a lot of benefit with the existing stores that we can to pull out a lot more top line and turnover with the existing stores. So that is exactly what we've been focused on in the last couple of years, which has provided rich dividend. We are quite confident even in the next year, we are not very bullish on rolling out very many number of stores. We may just add maybe about 3 stores in the coming year, 3 to 4 stores at best. So I think that is the pace we will be growing at in terms of store rollout over the next 3 years. And we also have slightly enlarged the definition of our business where we're looking at it more of a marketplace. So we also feel that today many of our warehouses are equipped to give a fair amount of direct delivery to various customers. So that we are not counting as really as stores, but there are multiple more points where we can give our services to the customers. So that is broadly an answer to your question number 1. I think the second part of the question was some sort of what is the steel and the non-steel kind of the business that we are on currently. So currently,
right, and also the margin profile, sir. Yeah.
Margin profile of the steel and the non-steel, right?
Yes. Yeah.
Steel, there has been a bit of an issue in this current year because we saw much of the first 9 months where the prices were generally going down. So that means we do take some hits on our inventory when the prices keep going down. So that is one part which has been factored in our current EBITDA. That is number 1. Number 2, when we look at broadly the steel business, we can expect in the region of around 2.5% to 3% in a long run is what is the EBITDA that we can really expect. However, in the non-steel, there is a significant upswing. We are seeing about 7 to 8% in the non-steel part of the business. So this is broadly the breakup in terms of the margins. If you look at the future.
Okay. And where are we looking at the online, sir, in terms of in the long term, 3 to 5 years? So currently it's only 80 lakhs a month, right? So where do we see that going to in terms of? Do you have any internal targets for that?
Yeah. So I think one of the key things that we need to do in the coming years is we have to market our online presence much more effectively. We have not yet allocated adequate amounts as a budget for the advertising and the branding. The non-steel is now being done through only digital and so on, which is still a limited reach. We have been very conservative on our spend in this year and the last couple of years on the branding and marketing spend. So I think as we go forward, we will be more confident to have a deeper budget for our branding and the marketing exercise. So we hope once that starts happening, the digital presence is much more widely advertised. However, having said that, the digital presence also helps the customer discover us. So what we find that currently the digital exercise does a huge thing in terms of it's like a product catalog that is online. We also have an app which is circulated with a lot of our influencer kind of customers who find it very easy to download the app and go through the range and the variety that is available. A lot of people come offline, and we are just tracking that because we are still in the process of our CRM, full-fledged CRM development. We are putting a lot of money down into the technology part, what we are trying to develop on the back end, both in terms of the continuous improvement on our website, the app, and so on. So I think there's a lot of footfalls that are being driven to the offline. We do get at least about 40 to 50 calls in our the toll line, which are directed from the website generally. So that is a very encouraging thing, which we consider as a retail sale. We don't really treat that as a digital sale. So digital, what we typically now are talking about, where the entire transaction happens through the payment gateways, through the digital platform itself. So this is where we are as far as the digital part goes. But again, one has to keep in mind in building materials worldwide, even if you take some of the advanced countries like America, etc., the digital sales of very large building material companies is still not significant in terms of their overall revenues. Because it's bulky, so people like to see a lot of the material physically. So it works well for smaller items, but not very well for this bulkier and the bigger items where people like, a touch and feel of the product.
No, because I was asking you in terms of your, you said your geographical diversification, right? So right now, much of it comes only from the south. So I was only trying to, because if you have warehouses at various places and if you're online, so I think in terms of reach to other states could be better. So I think my question was mostly on that. So do you see in terms of percentage of business coming out of the south, you're trying to increase that targetedly in terms of where you want to diversify, or?
No, currently, yes, you're absolutely right. We are very focused on the south, and we would further like to intensify our presence in this geography. We still have fairly large vacant spaces as far as the non-steel part of the business goes. So definitely we would be expanding further. You also had a very good point when you said the digital platform takes you into different territories, which it does. Very funnily enough, today bulk of our sales happens in the eastern sector of India and the digital part for some strange reason. So though we don't have a warehouse and we're shipping things out of, Bangalore and the closest probably Hyderabad to the eastern part of the country. So yes,
right.
Your point and your suggestion is well taken. Having warehouses in these remote places could possibly generate better sales, which will help on the digital platform.
Okay. Thanks a lot. So I'll just come back in the queue. I have a few more questions, but yeah, I will come back. Thanks.
Sure. Thank you.
Thank you. The next question is from the line of Nehal Jain from SK Securities. Please go ahead.
So I had a couple of questions. So what is the response of our latest launched app, and how much revenue are we able to generate via the app?
So we've had quite a lot of downloads. We're still waiting for the exact numbers. But we've had a very good response from our customers and influencers because they find it as an online catalog for them to show family members, other people, customers, and so on. So we've got a good response in terms of using it as a catalog and for shortlisting of items. But as we keep saying, building materials is an industry that people want to touch and feel. So we see that after a lot of knowledge and a lot of surveys are done, a lot of checking is done online, people do come back offline.
Okay, understood. And so we are majorly in south-based player, right? And so are we planning to add new cities in our portfolio?
Sorry?
As we are majorly south-based player, so now
Yeah.
Are we planning to add new cities in our portfolio?
Currently, we are a little, even our non-steel part is very, even more focused, very Karnataka, a little bit of Tamil Nadu, etc., centric, Kerala, etc. So we do have plans to very shortly open exclusive stores in Coimbatore, Hyderabad, etc., Vijayawada, and places like this, which would focus a little more on the non-steel part of our business.
Okay, got it. So do you see any difficulty for, Shankara to open a store in non-south region?
Operationally, we still feel that we've got a much better, we're already well entrenched in the south, which has a lot, for us, it is still, we feel that there's a lot more ability to penetrate further into the market. So it's a comfort zone, definitely. Operationally, warehouse-wise, delivery-wise, things are much easier for us over here. So, but definitely, we are looking at MP very seriously. We would like to penetrate a little further in interior Maharashtra. So these are the two areas we do have thoughts in the near future.
Got it. So is there a change in strategy or thought process, that before opening a store in the new region?
Okay, the strategy that we adopt before we open, first is, of course, why did I say NP? Because we've got a fairly successful both marketplace in Indore. So where we've already got an idea of the market. So basically, we start feeding in it with steel, so where we get some sort of a penetration and a comfort zone. And then we would start adding on the non-steel. That is for example. However, if we have to go to a brand new area where we are just not present, we would start it with a detailed market survey, get into and we do get some help from many of our principals, where they also guide us as to saying these areas are, the potential is good, etc. So I think it's a combined effort with some of our key principals and our own on the ground kind of a survey reports, and then we identify the location and then look to open the store.
Understood. And so one last question. Can you highlight more on APL business deal and like what is the contribution of the business in our top line?
Currently, we do about 70% of our tube requirements is bought from APL. So in our entire business, that would translate to about, and we also have a non-tube part of the business. So I will just give you broadly the numbers. It's about 40-45% is our total contribution of APL currently in the top line.
Okay. Thank you so much. That was very helpful.
Yeah.
Thank you. The next is from the line of Ashay Jain from Jain Capital. Please go ahead.
Yeah, hi, good evening. I have one question. So what is the broader view on the building material industry in general for the upcoming quarters?
See, what has happened is if you look at the COVID, post-COVID, I think a lot this year, particularly 2022, has seen a slew of projects coming up, announcements of new projects throughout, at least the South, and for sure, and I'm sure in many parts of the country too. But definitely throughout South India, there's been a slew of projects that were announced about a year ago. A lot of them are in fruition now. So the demand currently is very focused towards, cement, steel, etc. So if I take the bigger, the building material industry in terms of tiles and, plumbing and CP sanitary and so on, I think the real demand for those products is really going to kick in a very big way from the second quarter of this year. So I'm very, very bullish about the building material industry in the coming quarters. I know the last year has not been very good for some of these, the finishing products or the next level products of the building material industry. But I think probably after June, I would see a very bullish time for the, the rest of the building materials that take to complete the building.
Okay. Yeah, that's helpful. Thank you. That's all from us.
Thank you. The next question is from the line of Kanika Kothari from Kothari Securities. Please go ahead.
Yeah, hi, sir. Good evening. So, wanted to ask, what is your view on the building material industry in general for the upcoming quarters?
Yeah, I was just talking about it to somebody else, but very positive, I'm bullish, and considering our own current projections and the way the current quarter is also moving, I'm very positive about the building material industry.
Okay, thank you. And secondly, can you give some guidance on the margins for the next few quarters?
We would keep it, like I mentioned earlier, we will be in that around 3.5% EBITDA broadly in terms of our margins. And our top line is what we're very focused on. So for the coming year also, we'll be very top line centric, keeping around in that region of around 3.5% EBITDA.
Okay, sir. Thank you.
Thank you. The next question is from the line of Vandit Dharamshi from Alpha Invesco. Please go ahead.
Good evening, sir. Thank you for the opportunity and congratulations on the good set of numbers and our highest quarterly revenue. So I have 2-3 questions. First is on this competition and startup space. Do you think the competition is now becoming slightly less aggressive in terms of pricing?
Yes, I would say so. Definitely, I think maybe some funds are drying up. So, yes, I would think that maybe it's drying up, but then there are also other biggies who are coming in like JSW1, etc., where I don't think they will have any startup kind of issues.
Okay. And sir, other thing is on working capital. I think we have really managed our working capital well in a couple of quarters. So could you please, talk a bit more about our working capital? I mean, how are we trying to keep it controlled at, say, less than 30 days for this quarter?
Yes, this quarter overall our value has gone up, whereas we are able to do more cash sales, and we are able to control our debtors to around 30%.
I'm sorry to interrupt you, sir. We are unable to hear you clearly.
Is it audible now?
We are unable to hear. Your voice is sounding very muffled.
Is my voice clear?
Yes, please go ahead.
Okay. So I think in terms of managing working capital, I think the question was that how would we sustain this around 30 days of working capital, the net working capital which we are at currently. And it has come down over the last 1 year from around 45 days in the beginning of the year to 26, 27 days as in 43. So I think we are managing, though despite the increase in sales, we are trying to keep our debt broadly at a level of around 30 to 35 days. We're working very strongly to keep our inventory too in that same area. So inventory possibly around 30, 35 days is what we are trying to strike at. And we've also kept our creditors at a fairly, at a fairly good level. So I think with this management of keeping debt to a large extent at a low and keeping the inventory also at a comfortable level, I think that's that's how we've been working at over this last 3 quarters. And we hope to sustain to do the same.
Got it, sir. And so last one thing from my side, I think I just have one question. You spoke about increasing our spend in promotions and advertising. So could you just quantify, I think, what is the kind of number we'll be doing for FY23, and what is the kind of number we look at going ahead, say FY26, when we look at a 10,000 crore sale? What would be the percentage?
See, currently we have, like last year, we have spent most of it in the digital space and development of our, on the technology side, we have spent more than about 3 crores in this current fiscal. And the coming year, we really not spend much on the branding. Actually, the statement I mentioned was that we do not spend much, and we do not have, and we've really not allocated much on the branding marketing side. So in the coming year, we hope to allocate about 2 crores for the immediately for the branding and the marketing side, which is not very much, but we hope that we make a start with that and then slowly work on that forward. We really have not worked out what is the kind of spend we will have 4 years down the line. But definitely this is something that I can quantify you for the coming year.
Okay, sir. Thank you so much. If there's something, I'll come back in the queue.
Sure.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Arun Tirumalai from Tavasya Capital. Please go ahead.
Sir, you had guided the top line number. Sorry, I missed that. So if you can just repeat that. That was the first one. And secondly, I just wanted to understand the business mix. So right now, say out of the 9 months, almost say 50% is from retail, and channel and enterprises are growing faster than retail. So what would be your strategy and, regarding these, and is there any kind of profitability difference? I'm assuming retail could be better than the other two, but just wanted to understand that as well.
Sure. Earlier, somebody had asked me about a top line about, what would we be in about 3 to 4 years. So I mentioned the number of rupees 10,000 crores.
Okay.
So that was probably the part that you missed. And the second part of the question is on the mix and the growth of the retail versus the non-retail part of the business.
Yeah.
You commented that the non-retail has grown faster. Yes, indeed, it has grown a tad faster than the retail part of the business. We hope to sustain the 50-50 part of the business. It was around 57% used to be the retail and the balance of the non-retail part. So we hope to sustain that in that broadly the same ratio of about 50-50 or 53-50, 38 in favor of retail. So that is something that we would like to sustain. And yet, the retail margin will definitely be better than the channel and the enterprise. But as we have to take it forward on rapid growth, there is a need to push forward fairly fast on the non-retail part of the business.
Okay. Sir, and also on this, the APL Apollo, so since they also hold a small stake in the company, do you think, so just want to understand, you're saying almost 45% of the revenue is driven by APL. So will that come at a slightly differential pricing, or is it like, you could do, like your pricing would be similar to any other retailer for APL Apollo or any other channel?
I mean, our pricing would be similar to the market.
Okay. So you're not, so it's not inferior or superior to what you would, what APL Apollo's other distributors would get because they already have a stake in you?
Yeah, not really. I mean, in terms of as we buy such substantial volumes from them, obviously, I think they're able to command maybe a better logistics ability, better reach in terms of the market, as we're also present in multi destinations, where most of the other dealers would be restricted to, one state or typically one town or a destination or a district. I think we have some advantages, both which we provide APL as well as for ourselves, because we cover multi-region.
Okay. Sir, and also, are there any other benefits because of that, whatever the stake, what they have in the business? So are you looking at expanding this relationship deeper, or is there any thought process on that, if you can put some color? Or would they want to increase their stake in the business further, or any discussions to that effect?
No, there are no discussions to that effect. I think broadly it will remain at this point. And yes.
And so what is the overall capex that you're looking for in the next 3-5 years to reach 1,000 crores? So any significant capex, 10,000 crores, any significant capex required, or you're covered in terms of the current expenditure?
We do require, I mean, our capex is largely in terms of...
This is the operator. Sir, we are unable to hear you. Your voice is breaking and even it is sounding muffled. We are unable to hear you clearly in the call.
Hello, can you hear me now?
No, it is still sounding muffled.
Okay, I can hear you well. So is that...
Yeah, this is relatively better, sir, yeah.
Okay. So, sorry, I just got distracted at that. So what was your question, sir?
Capex. I was talking about capex. How much would you want to incur?
Yeah. So I think the key in capex that we require is in warehousing. We do require some sort of, mild processing in some of the steel items where we can cut and we can do certain small value addition to the end customer. So this is broadly the kind of capex that we're looking at, plus of all whatever we need to set our retail stores in the near future. So we are looking at broadly somewhere. We are sorry.
No, yeah. So I was asking, would you be able to quantify that? Yeah, sorry.
Yeah, I'm coming to that. I'll just explain to the needs of the capex. We will be looking at anywhere in the region of 25 to 30 crores per year for the next 3 to 4 years.
And so that can be funded largely through internal accruals, right? So you wouldn't need any borrowing. Okay. Thank you, sir.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Vandit Dharamshi from Alpha Investco. Please go ahead.
Thank you for the opportunity again, sir. I just have 2 quick questions. First being that by when do we expect the balance money for the warrants that we've issued to receive? I think we still have a couple of months left, I think. But last time you had guided towards end of this financial year.
We expect it to come probably in the first quarter of the next year.
Okay, got it, sir. And sir, one more question on our private label, sir. So as we scale, how do we see our private labels play out? Do you think there can be a concept of interest, or how do we grow our private labels if we are focusing on that?
Yeah. So we are trying to avoid, obviously, concept of interest with some of our key suppliers. So we do have a couple of areas where we can look at exclusively in, there are some areas, regions where we don't represent some of the key principles. So we are looking at tiles in terms of, one of the private labeling for ourselves. And we do have some of the hardware and the other items where we're looking at, private labeling.
Okay, sir. Thank you so much.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to management for closing comments.
Yeah, thank you everyone for taking time out of your busy schedule to attend this conference call today. It was a pleasure listening to a lot of you, taking up a valuable suggestions through your questions, and please feel free to approach us or FGA with any questions that you might have further. Thank you very much, and a good evening to all of you.
Thank you. On behalf of Shankara Building Products Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.